Busy Friday here after quite a week. Plenty of headlines to dig into from the Fed chair's speech yesterday, reiterating his view to the Economic Club of New York that inflation is still too high and that rates may still have further room to climb. Take a listen.
Does it feel like policy is too tight right now? I would have to say no. I think the evidence is not that policy is too tight right now. And we're at 5.25% to 5.5%.
That goes against our next guest's view. He says the Fed should not and will not raise rates again this cycle, despite what central bank officials may say. Joining us this morning, BMO Wealth Management CIO Youngyu Ma is with us. Youngyu, happy Friday. Good to have you with us. What makes you so certain, or at least sound so certain?
Well, we think those lagged effects of the Fed prior interest rates are about to kick in. And we're seeing that in some markets already. We're seeing that in credit growth. We're seeing that in the mortgage sector. We think that's going to have a surprising effect on the economy. And the strong data we've seen recently, of course, in the labor market, but also in growth, the GDP numbers that will come out soon. I think the best days are behind us. And although the Fed doesn't think now that rates are too restrictive, I think as data starts to soften in the coming months, the Fed will start to change its tune a bit and take a more balanced approach. So we don't think the Fed's going to raise rates again. We think we're going to be on hold for quite some time, though, and it's going to be quite a long time before the Fed actually thinks about cutting rates.
So as far as equities go, do you think there will be a moment where the market takes bad news as bad news? It's less about disinflation hopes and more about growth or earnings growth worries?
Yeah, it's a challenging point right now in the cycle, I think, because I think we're on the cusp of data starting to soften, but the Fed being somewhat behind that thinking. So until the data softens enough that inflation is clearly coming down to make the Fed more comfortable and change its messaging a bit, I think that we're in a point where both good news can be not favorably viewed because it might indicate that the Fed is going to be more restrictive, and bad news, of course, is bad news. So we could be in a point in time for a little while where everything is bad news, because we need to see the Fed soften its messaging, and we need to see economic stability here.
Well, a lot of it rests on what happens with inflation and how close they can get to target, how soon. What do you expect?
I think it's a long road. I mean, if we look at last month's CPI numbers, yes, in very broad terms, the trajectory looks decent, but there are some sticky components. And I think if the Fed really wants to point to the 2% inflation as being the firm target and really wringing inflation out of the system, it still has a ways to go, because you see areas such as auto insurance that are just still very high to the upside and very sticky inflation. So it's going to be quite a long road to get to that stable 2%. So that's why we don't think the Fed is likely to actually lower rates anytime soon.
What accounts for this move up in bond yields, especially at a time where there are geopolitical tensions? You would have thought that Treasuries would get a more safe haven bid. Mike sort of laid out what real yields are doing and the risk return there, risk reward. What do you think is causing it?
Yeah, it's a great question. I do think it's plain and simple supply and demand. The Treasury right now is issuing massive amounts of debt to fund to be able to have the money it needs for government funding. And in Q4, you have about $850 billion in Treasury securities that the Treasury has to issue. The deficit next year is supposed to be about 6% of GDP, so you're talking about another $1.4 trillion. And the question, when buyers feel comfortable stepping in and where the marginal buyer is going to price those Treasuries, I think that's what the market's feeling out right now. And if the Fed is going to stay higher for longer, as the market thinks, I think right now the 10-year Treasury will make sense right about where it is here.